At the heart of value investing lies a simple yet profound commandment. Don't watch the market closely. It's noise. Instead, watch the business. This principle urges investors to look past daily price fluctuations and focus on the underlying fundamentals of a company. But is this advice truly liberating, freeing us from the anxiety of market volatility? Or does it risk becoming a dangerous half-truth, tempting us to ignore important signals that the market might be sending? The tension between tuning out the market and staying informed is a central challenge for every value investor. As we explore this idea, we must ask ourselves, when does ignoring the market help us, and when might it lead us astray? In this investigation, we take a closer look at the wisdom often attributed to the quote in question. While its message may seem straightforward, it can conceal a subtle psychological trap that influences our thinking and decision-making. By critically examining this quote, we aim to uncover the layers beneath its surface appeal. To truly understand its impact, we will explore 3 essential loops that must be closed. These loops serve as key checkpoints, guiding us through the complexities and potential pitfalls hidden within the quote's advice. By the end, we hope to reveal not just what the quote says, but what it truly means for those who follow it. Imagine investing in a company you truly believe in. The business is thriving, customers are happy, and the future looks bright. Yet, day after day, you watch its stock price tumble, feeling a mix of confusion and anxiety. You wonder how something so fundamentally strong can be perceived so negatively by the market. The emotional roller coaster intensifies as headlines and opinions flood in, each offering a different explanation. In these moments, it's natural to question the wisdom of common investment advice. Is it really as straightforward as it seems? Or is there more to consider when a good business faces a falling stock price? A common myth among investors is the belief that watch the business means simply identifying and purchasing shares of companies that appear successful or popular. Many interpret this advice as following headlines, choosing firms with trendy products, or relying on general reputation. Instead of conducting thorough analysis, they assume that buying into well-known brands or industries guarantees strong returns. This approach often overlooks deeper financial health, competitive positioning, and long-term sustainability. The myth persists because it feels intuitive and straightforward, but it can lead to misguided investment decisions. True business analysis requires looking beyond surface-level appeal to understand the underlying factors that drive performance. Believing in the myth that compelling stories guarantee investment success can have serious consequences. Investors often become anchored to narratives, focusing on the excitement or promise behind a company rather than its actual price or financial fundamentals. This emotional attachment can lead to buying at inflated prices, disregarding warning signs and objective analysis. When market conditions shift or the story loses its appeal, these investors are left exposed to significant losses. Emotional investing, driven by stories rather than facts, increases vulnerability during market downturns, as decisions are made based on hope instead of reason. Ultimately, this behavior undermines long-term financial stability and can erode confidence in future investment decisions. In the year 2000, Cisco Systems was widely regarded as a leader in networking technology, boasting strong business fundamentals and impressive growth. Many investors were drawn to the company's reputation for quality, believing it was a safe bet for long-term success. However, despite its robust business profile, Cisco's stock price had soared to unsustainable levels during the dot-com bubble. Those who invested without considering the excessive valuation faced severe losses when the bubble burst. Cisco's share price plummeted by more than 80% from its peak, demonstrating that even the highest quality businesses can be disastrous investments if purchased at inflated prices. This historical example underscores the importance of balancing business quality with prudent attention to valuation. One of the most common mistakes in investing is assuming that a good company automatically makes for a good investment. While a business may have strong leadership, impressive products, and a solid reputation, these qualities alone do not guarantee future returns for shareholders. The key distinction lies in valuation and market expectations. Master investors understand that even the best companies can be poor investments if their stock prices are inflated beyond reasonable growth prospects. Amateurs, on the other hand, often overlook this crucial factor, focusing solely on company quality and ignoring whether the investment is actually priced attractively. Recognizing this difference is what separates seasoned investors from beginners in the market. When Graham Buffett and Munger advised investors to watch the business, they were emphasizing a deeper level of engagement beyond simply tracking stock prices. Their philosophy centers on understanding the underlying operations, competitive position, and long-term prospects of a company. For the value investor, this approach involves a two-part job. First, it requires careful analysis of the business itself, examining financial statements, management quality, and industry trends. Second, it means continuously monitoring how the business evolves over time, ensuring that it remains a sound investment. By focusing on these aspects, investors can make more informed decisions and avoid being swayed by short-term market fluctuations. The analyst's role begins with a meticulous examination of financial statements, scrutinizing balance sheets, income statements, and cash flow reports to uncover the true health of a company. This process involves sifting through numbers, identifying trends, and assessing management's decisions. Next, the analyst constructs detailed financial models, projecting future earnings and evaluating various scenarios that could impact performance. Rather than relying on market sentiment, the analyst focuses on determining a company's intrinsic value, using disciplined calculations and objective reasoning. This independent approach helps separate genuine opportunities from fleeting market hype. Ultimately, the analyst's rigorous process provides a solid foundation for informed investment decisions. The opportunist is a master investor who views the market as a tool, not a guide. Rather than being swayed by popular narratives or prevailing sentiment, the opportunist focuses exclusively on price, seeking moments when assets trade far below their intrinsic value. This approach requires patience and discipline, as opportunities may be rare and often appear when others are fearful or distracted by trends. By ignoring the noise and concentrating on the numbers, the opportunist is able to spot undervalued investments that others overlook. Their success lies in the ability to act decisively when the price is right, regardless of the market's mood or speculation. The original quote often suggests that investors should ignore the market entirely, but a more accurate interpretation is to disregard the market's prevailing narrative, not the actual price movements. For value investors, price serves as a vital signal, helping to identify opportunities where assets may be undervalued or overvalued. By focusing on price rather than stories or speculation, investors can make more informed decisions based on tangible data. It's important to separate market noise from meaningful information, using price as a guide rather than a distraction. This approach allows for disciplined investing rooted in objective analysis. When faced with uncertainty, the amateur often becomes anxious, allowing emotions and imagined scenarios to drive their decisions. They may fixate on potential outcomes, letting fear or excitement cloud their judgment. In contrast, the master maintains a sense of calm, approaching each situation with clarity and confidence. This composure stems from thorough valuation work completed beforehand, which equips the master to recognize genuine opportunities and avoid impulsive reactions. While the amateur is swayed by stories and speculation, the master relies on objective analysis and preparation. This fundamental difference shapes how each responds to challenges and capitalizes on possibilities. When advice is only partially followed, It can create a psychological trap. Individuals may find themselves stuck in a cycle of uncertainty, second-guessing their choices and feeling anxious about possible outcomes. This incomplete approach often leads to poor decision-making, as doubts and unresolved questions cloud judgment. In contrast, applying the full process provides clarity and structure. It allows for thorough consideration, reducing anxiety and fostering a sense of control. As a result, decisions are made with greater confidence, and peace of mind replaces the stress of indecision. Embracing the complete method transforms the experience from one of worry to one of assurance. The key takeaway is that genuine safety and peace of mind in investing are achieved through careful analysis and purchasing assets at a margin of safety. This approach goes beyond the allure of simply owning companies with strong reputations or impressive growth stories. By rigorously evaluating potential risks and ensuring that the price paid is well below intrinsic value, investors can better protect themselves from unforeseen market downturns. True ease in investing comes from discipline and thorough research, not from following popular trends. Ultimately, it is the process of buying wisely, rather than the perceived quality of the company, that provides lasting confidence and security. As we wrap up, consider taking a moment to reflect on the valuation metrics you personally rely on when analyzing investments. What factors do you find most meaningful, and how do they shape your decision-making process? Looking ahead, we plan to explore topics such as advanced valuation techniques, sector-specific analysis, and the impact of market trends on asset values. Your insights and questions are invaluable, so we encourage you to share your thoughts and experiences with our community. Engaging with others can deepen your understanding and help you stay informed about new developments in the field.